In 2022 and 2024, the S&P 500's total market capitalization rose from $30 trillion to $54 trillion, adding $24 trillion in value to the US stock market in just 2 years. As a reference point, it took 28 years for the S&P 500 to add $24 trillion in value between 1995 and 2022. Now, within the space of just a few weeks, we've seen the S&P 500 give back approximately $5 trillion. Many believe that this incredible melt-up we saw over the last couple of years was completely unsustainable, and that this recent correction is just the beginning of a major unwind, something that would make the Great Depression look like child's play. But before we buy into all of this doom and gloom, we have to transform this linear chart of the S&P 500 into what's called a log scale chart. Putting the S&P 500 index on a log scale helps us compare today's price action to what was going on in the 1980s and 90s when the S&P 500's market cap was much smaller. For instance, in 1985, the S&P 500's market cap was $1.5 trillion. By 1987, it was $2.5 trillion. Now, although in dollar terms, that's a much smaller increase relative to what we've seen today, but in percentage terms, both of these moves up was about a 70% rise in the S&P 500's market cap. So on this chart, the S&P 500's most recent move looks a lot more reasonable relative to what we've seen before in US stock market history. It's definitely been a very steep rally, but it's nothing that we haven't seen before. In fact, if we copy and paste the price action from the 1990s onto today, we see that the steepness of the rally in 2024 is actually incredibly similar to what it was back then. The only difference is actually that in the 1990s, the stock market continued posting the same kind of strong returns for multiple years after. So yes, we've certainly been in a very strong market over the last couple of years, but nothing says that we couldn't actually continue to see the S&P 500 provide the same kind of strong returns over the next few years, provided that we have the right kind of conditions for this type of market melt-up to happen. But the most recent sell-off in the stock market does put that scenario into question. Primarily having been driven by uncertainty around tariffs, many believe that this will have very real economic implications that makes that kind of stock market rally very unlikely and potentially even puts the S&P 500 at risk of major downside. Indeed, in order for the stock market to sustain a similar kind of uptrend to what we've been experiencing since 2022, we would need the same kind of conditions that we had in the mid-1980s and in the mid-1990s. Each of these incredibly strong periods of stock market performance had very specific conditions in place. When we overlay real economic growth on top of the stock market, we see that all of these big market melt-ups occurred when real economic growth was extremely resilient. In the 1980s and 90s, real GDP growth stayed between 3 and 5% on quite a consistent basis. Since 2022, we've seen real economic growth average at about 2.5 to 3%, which has been enough to sustain a very rapid advance in the stock market. So for this rally to continue, we need to see real GDP growth stay extremely resilient. The more complicated question, however, is whether Donald Trump's tariff policy is about to put a dent in the steady economic growth that we've seen over the last couple of years. The most direct negative impact of tariffs is that they mechanically reduce corporate profit margins. Lower corporate profit margins can lead to cost-cutting measures, which can often include layoffs, leading to rising unemployment, which is a typical characteristic of a recession where you see a steep decline in economic growth. This is why all the big banks have been lowering their forecasts for economic growth and raising their expected probability of a recession over the last couple of months. And indeed, tariffs have significantly increased the odds of economic growth slowing down considerably, which is why stocks have already moved down by 20%. But Donald Trump has also just announced a 90-day pause on these tariffs, meaning that tariffs are not being implemented just yet, which means that corporate profit margins won't get damaged straight away, which can mean that layoffs won't necessarily start immediately. Some argue that the 90-day pause does absolutely nothing to reduce recession risks as the economy will grind to a halt in these uncertain economic conditions. Others are saying that the pause on tariffs does reduce the risk of a recession, as the market will quickly gain clarity onto the situation while avoiding immediate negative impact and possibly lead to better trade conditions on the other side of all of this. We happen to be optimists if the Trump administration is able to bring clarity over this period of pause and that negotiations lead to favorable trade conditions for the United States, that we could see the economy narrowly avoid a recession. We also happen to believe that tariffs are not the only thing that can influence economic growth in the United States. And I can show you that by adding a simple line on top of the chart of economic growth in the US that actually predicts what real GDP is going to do over the next 8 months. This line right here is the inflation rate in the US, but it has been flipped around and it's been shifted forward by 8 months so that it basically predicts what growth is going to look like over the next 8 months. Now, that may look and sound complicated, but it's really not. Inflation represents the cost of living, but mainly the cost of living for essential things that are required for people to get by. Things like the price of gas at the pump, food, medical insurance, shelter. All of that makes up a very significant portion of the inflation data. If the cost of living for these essential things is rising, you can probably expect that people are going to reduce their overall spending in other areas of their lives. This is what many would characterize as a weakening of the consumer. As we know, when the consumer is weak, the economy weakens and potentially heads into a recession. So rising inflation or rising cost of living is a leading indicator of consumer spending and hence the economy. What we've found is that it takes about 8 months before a rise in inflation translates into a weaker consumer. And that is exactly what this chart shows. It predicted every single slowdown in economic growth going back to the 1980s, with the exception of COVID, that was of course induced by the pandemic. In each of these examples, inflation rose, and then 8 months later, real economic growth collapsed. Over the past 8 months, we've seen inflation remain quite steady, which to us suggests that we should be expecting economic growth to remain quite steady, at least for the next 8 months. There is a big caveat to this, of course. The pandemic was a great example of how an external shock can cause a recession without a spike in the inflation rate. An extreme tariff policy today, or even high levels of uncertainty in the marketplace, could end up making this chart look something like this. And again, many people believe today that's what's going to happen. We are not PhD economists, so we're not taking a big stance on this right now. But if we see the economy avoid a tariff recession right now, then this chart is telling us that the economy could actually continue to hold up quite well throughout the rest of 2025. Now, you might be thinking that we are relying too much on government data here, and you're right. In trading, we always have to cross-check our information with other sources. Plus, if we just use the government's data, we only get monthly updates on inflation. We much rather have a real-time view of what is happening with inflation. So for this, we constructed a basket of publicly traded commodities that can tell us what inflation looks like in real time. This includes things like the price of cotton, wheat, corn, soybeans, but also the price of metals like copper and nickel that are essential in manufacturing. When mixed all together, these commodities give us a broad sense of what inflation looks like day to day. This is what this basket looks like on a chart going back to 2016. And if we plot it against the rate of inflation in the US, we see that it does do a very good job at telling us what inflation looks like in real time. Right now, our basket of commodities is telling us that inflation is indeed remaining quite stable, just as the government's data is suggesting, at least for now. Again, if we were to see a pickup in the price of commodities here over the next few months, you'll start to hear some different things from us regarding the economic outlook, provided, of course, that Donald Trump's tariff shock hasn't already pushed the economy past the point of no return. We really are at a make or break point for the US economy. Avoiding a recession in the near term could mean seeing stocks continue a very healthy bull market throughout the rest of 2025, but a recession would, of course, lead to more pain. Luckily, as traders, we don't need to make a call on this right now. Our trading strategy is based on making high probability trades yielding large returns during favorable market conditions. The goal for us in these current conditions should just be not to get ripped apart by volatility. This is why we currently still have a very conservative approach in today's market environment until we see an improvement in the technical and internal structure of the stock market. At that point, we'll start to initiate trades much more aggressively again.